After Tesla's recent 3-4-1 stock split, you might be wondering if now is the ideal time to buy Elon Musk's dynamic electric vehicle company. The split has not been beneficial for the stock. Its price has declined nearly 10% since it took effect. But that decline likely has more to do with the larger market sell-off since concerns around prolonged inflation continue to punish equities. Long-term investors understand that declining stock prices create potential buying opportunities. So with the tech-heavy Nasdaq Composite also down more than 10% over the last few weeks, what is the better opportunity right now, Tesla or a Nasdaq index fund? If you're an investor with a strong stomach for volatility, I believe Tesla offers greater potential due to its many similarities with other once-in-a-generation stocks. Many of the greatest companies today have one thing in common: they flip traditional business models on their heads. Tesla has done this in many ways, but none are more apparent than its manufacturing efficiency. This has largely been accomplished by Musk's first principles approach to building his cars. Atomic Habits author James Clear defines first principles thinking as the act of boiling a process down to the fundamental parts that you know are true and building up from there. The average automobile consists of about 30,000 parts. By contrast, the Tesla Model 3 is made up of around 10,000 parts, and the drivetrain has only 17 to 18 individual pieces compared to a standard internal combustion engine, which has around 200 parts. Tesla has been able to achieve this manufacturing efficiency through its Giga Press, a large-scale die-casting machine. Instead of casting thousands of individual parts and welding or gluing them together, the Giga Press can produce large portions of the car in a single cast. For example, the entire rear section of the Model Y is cast in a single mold, which would traditionally consist of over 70 individually produced parts. This innovation alone eliminates approximately 300 robots and reduces the body shop space by 30%. This manufacturing efficiency can be seen in the company's operating margins, which significantly beat the competition. The biggest oversight many investors make when analyzing Tesla is thinking of it as simply a car manufacturer. You've likely seen the various articles pointing out that Tesla's market capitalization equates to roughly all of the other major automobile manufacturers combined. While Tesla's leadership in the electric vehicle space certainly contributes to its lofty valuation, I believe the main justification has more to do with its data-centric business model. Tesla vehicles are essentially computers on wheels, and just like all of the best companies today, the company is leveraging the data captured by its computers to maximize its value proposition. This is clearly seen in its push toward autonomous driving. While Musk has been infamously overly optimistic about the release of the company's full self-drive feature, Tesla has been beta testing it for nearly 2 years, and recently surpassed over 100,000 vehicles on the road actively testing the software. For reference, Alphabet's Waymo, a major competitor in the autonomous driving space, has an estimated 600 autonomous vehicles being tested on the road today. FSD is built on a foundation of machine learning, so each mile driven by owners is in theory enhancing its capabilities. Tesla's lead in testing autonomous vehicles is just one example of how it's using its proprietary data as an advantage over its competitors. Other examples of the company's use of data capture can be seen in its metric-based insurance product as well as its over-the-air software updates. Tesla's valuation is without a doubt the biggest concern for buying the stock. With a price-to-earnings ratio of over 100, there's not much of a claim that the stock is cheap. But while that valuation is high, consider how drastically the price-to-earning has been reduced over the last few years. This is in part due to the pullback in the overall market, but it's also a result of Tesla's dramatically increasing profitability. Tesla isn't a value play, but a bet on optionality. Even at today's lofty prices, I believe there is tremendous upside if the company delivers on its wide array of disruptive products: autonomous driving, robotaxis, robotics, solar energy, and more. Very few of the highest valued companies today ever traded at traditionally cheap valuations. There is certainly risk baked into this investment, but the range of potential outcomes for Tesla is astronomical, and it reminds me a lot of another high-flying technology company that was critiqued for years as being massively overvalued. It's Amazon, whose founder, like Elon Musk, also sends rockets into space. Tesla's stock has been on an electrifying run this summer, and it may not yet be over. Shares of the electric vehicle maker are up 12% in the last 3 months, handily outperforming the S&P 500's nearly 5% decrease over that time. Wall Street credits the push higher in Tesla shares to optimism around new government legislation that will support the adoption of electric vehicle in 2023 and beyond. Tesla's strong execution in the first 2 quarters of the year has also won over the bears. Despite the stock's rise, Goldman Sachs analyst Mark Delaney believes there is more upside to Tesla. Delaney's hot take comes after a meeting with Tesla's head of investor relations Martin Vaicha. Here's what Delaney had to say on Tesla following that powwow. Tesla's automotive cost of goods sold per vehicle fell to about $36,000 in 2021 from over $70,000 in 2017. While this metric increased in the second quarter driven by factory shutdowns, factory startup costs, and input cost pressure, cost of goods sold per car can trend lower over time as Tesla benefits from the ramp of the Berlin and Austin factories, and the reduced percentage of vehicles coming from Fremont, which is a converted ICE factory with higher costs than Tesla's purpose-built electric vehicle factories, scale, and vehicle platform and battery improvements. It's too soon to say what impact the Inflation Reduction Act will have for Tesla, and a lot will depend on guidance from the government about how the law will be interpreted. However, we note that the IRA does seek to encourage a North America-based electric vehicle supply chain, and Tesla has more local manufacturing than average, with Model 3 and Y recognized as the most American-made vehicles per media sources, and we believe this will be a positive for Tesla to potentially qualify for at least partial credits on some vehicles over time, and Tesla could potentially benefit as well in our view from incentives for solar, batteries, charging, and commercial vehicles. In September 2017, General Motors CEO Mary Barra and her top executives visited the automaker's design dome, considered hallowed ground within the company for its role in creating General Motors' most iconic vehicles. Displayed under the showroom lights were about 10 true-to-size clay models of electric vehicles, including designs like the automaker's Chevy Corvette and a host of crossovers and SUVs. At the time, much of Wall Street's attention was on the nearly $400 a share price of Tesla, whose celebrity CEO, Elon Musk, was promising to lead the world's transition to more sustainable energy. The showcase at General Motors' sprawling tech campus in suburban Detroit gave executives a glimpse at how they might outpace Tesla and longtime rivals such as Ford Motor, which were also eyeing the buzzy electric vehicle market. The clay models were examples of the range of electric vehicles General Motors could build through a new platform the automaker was developing. Mary Barra's electric vision. GM's strategy for an all-electric future was forged over meetings in September 2017, according to executives who were present. Underpinning the plans was a new platform, now known as Ultium, dedicated to electric vehicles the company was developing. Production from GM's first plant with the new technology started late last year. GM's work on EVs had accelerated after executives in 2015 traveled to Silicon Valley to research emerging trends and meet with Apple CEO Tim Cook, Google officials, and others. In the following days, executives met multiple times to discuss the platform's potential and to hash out a strategy on electric vehicles, according to several people who were at the previously unreported meetings. That was the week General Motors' path was decided, said the people, who declined to be named because the discussions were confidential. The following week, General Motors publicly declared its belief in an all-electric future, marking a pivotal moment that would start the legacy automaker on its most ambitious shift since its founding in 1908. General Motors stock that week jumped more than 11% to about $45 a share, marking the largest weekly increase at the time under Barra's tenure as CEO. The gains would last only a few months but deepened executives' conviction that they had picked the right path.